Today, I'm chatting with Greg Dean, the founder and chief investment officer of Langden Equity Partners, a global small-cap fund manager operating out of Toronto, Canada. I love this chat. Greg is incredibly passionate and his team really put in the work to uncover hidden gems all around the world. I first discovered Langdon through a series of reports they wrote called The Anatomy of a Compounder, and I actually invested in the fund myself shortly after reading that series. So it was great to get to know Greg and the business on a deeper level.
Greg, let's start from the very top. Can you give us a bit of an overview as to what Langden Equity Partners is and does?
Absolutely. Appreciate Owen the time we get to spend today and time spent with your listeners. Langdon will be 3 years old next month. We're a specialist investment firm focused on global smaller companies. So companies that we've identified have the attributes of entrepreneurial, people-led businesses, and that's typically between 500 million in market cap to $500 million. And we've been doing that now for over 10 years across 23 developed countries. And the team has only grown in size over time. So we now feel like we're adequately resourced and I'll have a lot of opportunity in front of us.
I'm curious as to the pitch for small companies, for global small companies, because we're sitting at a period in time where if we look back the last 10 plus years, it's been, when we talk about international investing, especially say sitting here from Australia, we look at the very large dominant US companies like the Mag 7, and it's been hard to make an argument to the person on the street that, hey, they should look outside of those large caps because they have had such a good return. So what is the argument that you guys make for saying, hey, adding small caps to a portfolio makes sense?
I love that question, and also find that to be the most common question when people are looking or thinking about us. And this isn't just true of the last number of years with the Mag 7 phenomenon. I have to take it one step back. Nobody needs to invest in small caps. It's not a benchmark in a superannuation portfolio. It's not a main food group, we call it. And yet the reality is the compelling reason you should is often so far down the list of considerations that it doesn't even come up, because the reasons not to are quite innumerate. And so, and I've been on record as saying this sort of narrowing of the market that you referred to, the Mag 7 phenomenon, what we used to call the FANGs, when people started changing their minds on which companies got included in this thing.
Back in the old days.
The nifty 50, if we want to go back to my grandfather's time. The point is, there's always something that's happening and capturing the imagination and the attention of the investment community or the savings community at large. And it's often, the longer it persists, the harder it is to say it will ever revert. And the reason this time I think is maybe as of recent times was the most dangerous is because it's happening in such good companies. Everybody can point to the tech bubble and say, oh, EV to eyeballs, and that just pets.com and you name it.com, companies adding .com and going up tenfold in 3 weeks. Thank goodness that wasn't in what I would consider to be like main food group businesses or asset classes, because it was still very painful and jobs were lost and wealth was destroyed, but not in the quantum of what we're looking at today with, these very good companies with very reasonable tailwinds getting to elevated valuations that may or may not persist. So the thing I look at is, the S&P has done 15% for 15 years, roughly. I'm a mathematician by training. Like there'll be a gravitational force that we'll look back on and say, that was a lot of value creation in a relatively short period of time. And so we're not here calling for any, demise, but it could be like what the concept we float to clients is, what if beta did 0 for 5 years? right? Like these companies just have to grow into their multiples. They're still good companies. They're going to be around. You're still going to pay for Netflix. You're still going to use your iPhone. You're still going to be either searching or querying things on Google. But maybe you've just gotten too much credit from them in too short a time. So what we've kind of avoided, going back to your question, is the timing element for smalls. If you're debating the timing, then it's not for you. And you have to find a manager or a team that can deliver a through the cycle return that is competitive with anything else. And so we see this all the time. You know, some smallers manager or EM manager or high yield manager will say, I beat my benchmark. And then, you know, you look a bit below the surface and you realize that their benchmark was, you know, 5% below large caps for 5 years. So yeah, you beat the benchmark, but you didn't compete with the other, you know, more mainstream alternatives for wealth creation, wealth preservation. So maybe that's a good job. Maybe it's not. What we've sort of set up Langdon to harness is delivering, you know, a through the cycle return that can compete with whatever end clients own. I've only had mums and dads and end clients as clients for my entire career, going on 15 years of managing small cap portfolios. And they don't think the same as, you know, endowments and foundations and non-taxable entities. And so you got to think about who your clients are and the types of clients you want to have and what's important to them. And it's not a Sharpe ratio or a Sortino that, you know, is best in class. It's making sure that the shape of the ride is comfortable and the end destination is attractive relative to their alternative. So, you know, we talk about wanting to deliver mid-teens net returns and have done that now for 14 years. So that's sort of why we think smalls is the largest collection of homogenous opportunity in the developed world. Like we have 4,000 companies we could invest in. We choose to invest in 35. And so there's always 36 things that are interesting and mispriced, you know, and that's why we think the asset class is attractive. And also because there's large pools of capital that are structurally set up to avoid it. And so you've got less competition, more opportunity than large cap by a factor of 6 to 1. And in most big firms, they're all oriented around size because they're managing such huge pools of capital. So they're not putting their top talent or their best foot forward in this asset class. And that has created that's a big reason why we thought an independent firm was necessary to extract the value from the asset class.
That is a fantastic answer. There's lots in there that I wanted to talk about, but the one thing I want to come back to, because so many people don't say this or acknowledge this, it's actually quite surprising to me when I talk to fund managers. You talked about the people that you serve, you know, your clients and what they care about, and they don't care about going, oh, congratulations, you beat the small cap benchmark. They're sitting there saying, yeah, but this got this. You know, they're talking about, you know, the alternatives that they actually physically could have got if they had picked up their money and parked it in an ETF somewhere else or something like that. They're not sitting there going, well, yeah, you beat your benchmark, but the benchmark return was crappy.
It cuts both ways too, because, you know, our NAV has been put up against every episodic attractive thing in the last 15 years you can imagine. And you know, even in, you know, because we're in Canada, it's like there'll be a 3-year period where oil and gas does better than us. And it's like, well, were you ever going to put 100% of your net worth in the oil and gas sector? Probably not. So I wouldn't lose any sleep. You know, sometimes it's not about, you know, return maximization. If that thing that they're comparing against has had 3 drawdowns of 50+% in 5 years, how likely were you to be, you know, buying it and selling it at the right time versus buying it and selling it at the wrong time? So when we think about getting our clients to that end destination, it's just as much about drawdowns and managing through volatility as it is about, you know, attractive returns. And so that is the combination that we obsess over. It's not just the component pieces that we talk about selectively when it looks attractive for us.
I just want to go through a couple of questions here about how you run your team. Talking about Langdon, the collection of people that you've got. How many in the company? How many analysts? And how would you describe them?
We actually, you know, having worked at a couple, you know, big firms in my career prior to starting Langdon, I never enjoyed. I didn't like this portfolio manager analyst, you know, description of the world, because what it felt like to me, having lived through both of those roles at more traditional firms, was, okay, analyst, go do great investment research, come back to me, decision maker, portfolio manager. I'll decide whether I agree with you and what to do. And so when you separate the investment decision making from the investment research, you've already failed, in my opinion, because those two things need to be hand glove. And the best opportunities when I was early in my career in an analyst role were when the portfolio managers were with me for the access and for the discussions and for the interrogations of the companies and the visits to the sites, because they have a lot of experience. They've seen that company through good and bad and up and down. And so that it can benefit you tremendously as a more early career person. And then vice versa, as a portfolio manager, the worst outcomes were the ones where I asked somebody what they thought, but I didn't participate in the research journey. So when we set up Langdon, we said everyone is going to be an investor here, because investors do great investment research and can make great investment recommendations. If you can't do both, this is not going to be a good home for you, because we aren't going to pay people to write 40-page white papers that don't get actioned, nor are we going to, buy people or hire people who are good at picking managers, but can't actually conduct the investment research and help people in that way. So the team is a collection of obsessively curious, passionate people who see the world of investing as, puzzle solving. This is a company that, I want to take it apart. I want to understand how it works. I want to put it back together and make sure I can do that without the instruction manual, because then it will help me really feel like I understand the business. And then I want to do the same thing with the team. I want to get inside the mindset, or what we call the engine room, because a company, the output of the company is that's the end state. Like, that's the lagging indicator. The results were based on decisions from 3, 5, and 10 years ago. You're trying to get into the engine room to underwrite future decisions. How will they handle tariffs? How will they handle 5% interest rates? How will they handle competitive pressures or the loss of a large customer? Sometimes it's even just, more, being a math person originally, I didn't think there'd be this much investor psychology or human psychology required to be a successful investor, but it's massive and it isn't really taught. And so that's a lot of stuff you just pick up, through experience and then through training. And so the group is, we had one sentence bolded and underlined in every single job posting that we've ever put out. And that was demonstrated passion for investing, because it's the one thing we can't teach. You want to understand balance sheets, income statements, interrogation skills under duress. There are experts, and we ourselves can help you through a lot of that stuff. But if you aren't passionate about this stuff, you will get outworked and you will not be able to be successful at the bar the standards that we have for ourselves. So that would be how I describe the team.
I love it. When I used to put out, job ads filling a client services and fund sales team, I would always put something in there that says to the extent of, tell me you want this job. Like, I don't implicitly say that, but I put words there into the effect of saying, hey, you tell me, and that is what I gravitate towards. You tell me why you really, really want this job, and looking for passion, because you're absolutely right. You can't teach that. You actually previously mentioned that your investment universe is about 4,000 companies. How do you actually get to that point? Because when you actually look at the investable world in the developed markets, there's far more than that. And I've heard you previously talk about the quick no's. So because when you are sifting through literally tens of thousands of companies to whittle it down to 4,000, which still seems like a huge amount to sift through, return on time is incredibly important for you and your team. So what are those quick no's that you look for to say, hey guys, let's work more on this?
Return on time is also a unique to small cap issue, right? Because our team meets the S&P 500 basically every year, or the equivalent of the S&P 500, and so it's much more of like a, if you think of like back to hunter gatherer times, large cap is all about gathering. incremental data points on the same couple hundred companies that 30 other people are obsessing over every quarter. Small cap, you can tell I'm biased, right? I've done large cap, so all of this is from my own experience. And I remember one of my old bosses said, there's 1,000 ways to get to the finish line. You just got to find the one that works for you. And I think, for me, this is the combination of underwriting people and companies is that right combination. But small cap, there's so much hunting. Hunting is a huge part of what you do and a huge part of your time. It's important to have those guardrails because you can get lost in the hunt. And then, your clients the outcomes are tied to what you own, not what you don't own. And so, that's the reality. And so we have developed what I think is a pretty sophisticated set of, kill criteria, but it doesn't really narrow it. I'll tell you about the what I'll call the standard issue, not that smart. We call them the not that smart screening criteria. It's, sector, size, region, and liquidity. Those 4 things are just table stakes, but that's the extent that we're willing to outsource the screening to the computers. We think it's a total, misrepresentation when you then outsource valuation criteria or growth characteristics or profitability metrics to the computers, because all they can tell you is what's already happened. And so we think not only is it a big, factor tilt that you're imposing on everyone wants to look at a manageable number of things, 200 things, 250 things. Like, I've never met a fund manager that had a different number. But how we get to the 4,000 from the bigger universe are those 4 things: sector, size, region, and liquidity. So we want to be in countries with sound rule of law, enforcement of property rights, relatively stable currencies. So we're developed countries only. We only invest in 4 sectors because we've looked at everything in all these different sectors. But the companies that can best control their destiny are the ones that can avoid commodity price risk, currency risk, interest rate risk, and government policy risk. Those 4 things, if our thesis hinges on one of those 4 things, we're in trouble because we can't control them. No one can. I haven't met a lot of good predictors of those things over my career. And so we ideally want to immunize ourselves from those things. And so we don't look at real estate investment trusts. We don't look at pipelines. We don't look at utilities. We don't look at banks, anything that requires leverage to earn a satisfactory return. People will talk about how much money they've made in real estate. It's because they were levered 20-1, right? With the down payment. And so after, on a levered basis, it's a great return, but on a fully equitized basis, you might compound at GDP or below, certainly lower than our hurdle rate. So we try to avoid leverage, but some of those mid-funnel quick no's can be excessive management turnover. The business output might look great. And this was something, that we identified with Domino's Australia, which I know is like the most discussed local company, in your neck of the woods. But I had met Don multiple times in my career, and he was the stability, and the CFO was the stability, but everybody who reported to him turned over every 3 years, both of them. And so you have to look at that and say, okay, what's going on here? How come people can't last more than a year or two? And some of it was internal promotion, which was seen as a positive, but in a lot of cases they left. And then when there is that significant turnover, we look at where did they go and how are they doing? It's not just a checkbox exercise. It's, if they've gone on to better things and have gotten, into high performing roles with high performing companies, why did they want to leave? And so that's a big one that I think is not as often discussed. We also look at the level of adjustments, the old school Warren Buffett approach of start at the back. When you're reading the report, start at the back, go through the notes. If there's 80 pages of notes and 13 versions of EBITDA, that's a problem, right? That's saying that they can't, the best companies don't adjust. They just put everything through the P&L. There's not a big capitalized or amortization of intangibles that is going on. It's just fully expensed. And then another good one is management comp. Are they trying to get rich through compensation or get rich through ownership? And we obviously much prefer the latter. So those are some of the quick no's that we can, bring to bear in a first meeting to figure out if there should be a second meeting.
That's really good, looking at that second layer of management. And that's something that seeing that tenure is something that people can do themselves, right? They can jump on LinkedIn. I mean, I know the individual on the street here feels like they can't, go in and request a meeting with management. But you can go onto LinkedIn, you can go down to that second, third level of employees, and then you can just, make a note. Right. When did they start? How long have they been there? Come back in 6 months' time. Are they still there?
Their biographies on their website too. It will typically say when they joined the company and how many roles they've had at the business since they joined. So you can get a sense for how much, executive mobility, for sure.
Let's jump into something that first caught my attention about Langdon. When you first came on my radar, I love this series that you guys wrote up called The Anatomy of a Compounder. One quick thing, actually. When I jump onto your website and when I read this series, when I look at interviews and whatever, I actually see so many different names. And that's really interesting to me. We've got this analyst writing this piece and it's on the website. This analyst appearing on TV in the US or in Canada. You're doing a podcast here or there. And I like seeing that. It's not just the Greg Dean show. I think that's really I think that's on purpose, yeah?
You don't collect a group of high-performing people if you get in all their way. Right. Or you want to, handle all the most important or be responsible for the most number of things. I think you build this you collect this high performing group, and then you basically want to give them autonomy and responsibility, but be there to provide support. And so as quick as people are capable, they're writing interesting pieces, especially if they came up with the idea. Take it to the next stage and actually put pen to paper. It's hard. It's hard to write in a tone, take a concept and actually be able to distill it into its elements and be able to communicate it in a way that people are going to understand, but where you still retain the the originality and the purpose of the communication. And so for us, this is super important. Like we didn't touch on this earlier, but we have a $5,000 minimum on our Canadian portfolios, and it costs us a significant amount of money to do that. But we wanted to be made available to everyone. This idea that your income or your net worth will dictate who you can invest with and how much you can invest. Like that was a non-starter for us. So there's no walled garden around our website. We communicate openly and transparently, and in many cases to our detriment because our competitors can see what we do, but we're okay with that. We think that making investment excellence for everyone available to everyone is important.
Yeah, I really love that, and I'm gonna come to that in a bit. But something that I have picked up through my time of looking into you guys is you spent time at a very large institution with Fidelity. It's known all over the world, and that did shape you as an investor. But I think what a lot of things that you take away from a previous role or business that you've been in is not quite often how you're going to do things, but it's how you're not going to do things as well. And I get a real sense of that has really shaped your investment approach, but also shaped the business that you and the guys have created over there. So I've teased the listeners enough with this next section. What is a compounder? Can you tell me, Greg, what the formula for a compounder is in your eyes? Because this is incredibly important to your investment process and the end outcome for investors.
I can do that, and I will, but I need to caveat that this has become a buzzy term, right? The notion of compounding, compounders, in many ways it's a good thing, because the power of compounding it's like, it's like gravity. It's real. It's very profound. But how you arrive at the ability to compound at outsized returns is not as straightforward as it sounds. And so I'll go through what we say is what we're looking for to find a business that can compound. In a very simple description, it would be a number of opportunities to commit capital to, all of which have high likelihood of providing high returns on invested capital, right? If you can find a number of ideas. So both the idea velocity and the outcome of the idea both need to be significant for the compounding journey to occur. And so that what that breaks down to in investment buzzwords are things like returns on invested capital need to be stable and improving. And then your reinvestment rate, so the amount of cash flow that you generate that you can redeploy into those ideas, needs to be significant. So somewhere between 50 and 80% of the cash flows are being reinvested back into the business. That's how you can grow the earnings power of a company at a high rate for a long time. And so most companies have one of those two dimensions. They have current high returns on capital, but they don't have a lot of incremental ideas to commit capital to, or their existing ideas. Like we think of like the banks in Canada. The reason that they're in so many other businesses is because they can't put all their cash flows back to work into the Canadian mortgage market because it's an oligopoly and it's growing at not a very high rate. So some of them have built out investment banking franchises in the US or wealth businesses in Latin America. And that's because the amount of capital they have exceeds the amount of ideas they have in those high return opportunities. And so the flip side is also true. Sometimes you have a lot of ideas, but you don't have a lot of capital. And so that is not going to lead to successful compounding because you're probably going to have to dilute your existing investors every time you want to fund a new idea, whether that's through equity capital. And so it's, again, one of the reasons why we avoid what we call income pass-through vehicles. If you're paying out 95%, it's really hard to compound. You can't compound a dividend, right? So you have to retain capital to compound capital. And so, but the Surgeon General's warning here is that the math of compounding is better known today than it's ever been. But in order to earn a high return or an outsized return, you need to have a belief about a business that is not widely believed by others. So that compounder checklist, high returns on invested capital, high reinvestment rate, strong ability to convert net income to free cash flow, all that stuff is true. And then, attractive multiple, but you have to then, the market has to disagree with you on one of those things for you to have found an attractive investment opportunity. So that's the caveat, is the obvious stuff is obvious, but the non-obvious thing is you have to have that belief about a business that not everybody shares, or else it's probably not a long-term compounder.
So cash flow as well is one of your North Stars. I like this quote that you've previously said on another podcast. It is important to us that the stewards of our capital can articulate their reinvestment philosophy and that it translate into higher cash flow per share over time. Can you tell the listeners why this data point is so important for you?
Yeah, I think, again, this is where I am always fascinated by the world of investing, sort of living within a bubble of real life, because at the end of the day, everyone's an investor. They're choosing where to invest their time, whether it's in their job or in a other pursuit. They're choosing, if you're deciding whether to buy out your lease, or trade it back to the dealer, that's an investment decision. It's all about the cash on cash return. And so what we tell our companies is, that's investing in its simplest and purest form, is just distilling what you do or what the business's outcome or objective is into its ability to take cash from investors and then generate cash from that investment. And that cash on cash return, no different than real estate, is what ultimately we're hiring companies to get right. We want to earn 15%, net of fees. That means they have to be finding productive things to do that generate north of 15%. And then we have to make sure we don't overpay for that opportunity or franchise. So that's what we think great companies do very well. And they have all the tools. There's many tools in the toolkit. It could be, investing in a sales team, hiring organically. It could be acquiring a competitor. It could be knowing when to buy back your stock and knowing when to not buy back your stock. Like, there's a whole framework around capital allocation. But if without cash flow, I don't know what you're valuing or underwriting at the end of the day. And this is a problem because the stock market is pretty good at underwriting earnings. Every time a company reports, it's like 6 seconds later, the headlines are showing up down your terminal. Earnings were this, guidance is that. But like, what about the cash generated? Sometimes the earnings are $2 a share and the cash generated are 10 cents, or the cash generation was negative. And so that earnings per share is irrelevant unless it's translating to cash flow at some reasonable rate over time.
And one thing in the series that I found really fascinating is traditionally when people think about compounders, they do think about those really businesses that can reinvest it. And you have mentioned it, reinvest it in high rates, retaining that cash and putting it to good use in the business. But I remember in the series you guys spoke about, there's actually a series of pretty remarkable businesses that can actually pay out a dividend and still self-fund. You mentioned a few. There was a few specific ones mentioned in the series, but I'm interested in hearing about that. What does that look like, paying out a dividend? Because I know in Australia, our investors here, very, very dividend focused. But what does that self-funding look like when they're not retaining all of that cash?
Yeah, the list of we break it down again into sources and uses of cash. So every business that we look to underwrite, we're trying to understand historical sources and uses of cash, and we'll kind of visualize this. Think of like a pie graph. Where did the cash they've generated, from inception to today come from? How much was paid in capital, which is like investors writing a check into the business? How much of it was cash flow generated? How much of it was from raising debt? That's sources of cash. Uses of cash is, investing in their business, acquiring additional businesses, paying out dividends, those buybacks, those sorts of things. And so sometimes what I think different companies can get wrong is they understand all the tools, but they rank them in the wrong order, right? Like dividends come at the end, and it's only with what's left over. That's why it's a dividend, right? But some companies, it's dividend. Got to make sure we pay our dividend. And then if there's some cash left over, maybe we'll hire some people. And if there's no cash, maybe we have to fire some people because we got to keep that dividend. And so that is, backwards in our view. And so, we find these great compounders, again, probably before that term can be used to define them. Like probably the career defining investment for me, both in terms of my investment approach, but also to relationship building and company identification, was a company called Couche-Tard, Alimentation Couche-Tard, which is a Canadian-based convenience store retailer. They're now more probably well known as Circle K.
That's not familiar to me, but
they tried to buy Caltex a few years ago.
Oh, really?
They're a $60 billion chain of convenience stores, largest in the world.
Did I hear they were attempting to buy 7-Eleven?
Yep.
Is that right? Yeah.
Yep.
Yeah.
So these five, I promise I didn't plan this either, but here's the founder.
Oh, g'day.
And his biography, which is out of print. It's on my desk because I'm sending it to one of our CEOs. The out of print copy that I have, and begging him to give it back to me when he's done. But he actually, in that book, they reference my old boss, Alan Radlow, on page 189 and talk about how instrumental he was in funding their expansion into the US. And so this is a business that started with 5 founders in Laval, which is a small town outside of Montreal in Quebec. And, they're now, a $70 billion company with probably 15 billion of invested capital, maybe more. And they've compounded that invested capital at 15% for 30 years. And their returns on invested capital are north of 25% cash returns on invested capital. So when you can find one of these businesses, you can get an earnings compounding that over many, many decades surprises people. And then because it's a convenience store retailer that sells fuel and, wiper blades and gum and Red Bull, it's not trading at 45 times cash earnings because it's nothing novel or interesting. And, when we found it, it was in the middle of the financial crisis. So, consumer confidence was like record lows, fuel margins were record lows, property prices in the US were negative in some places. And so nobody wanted to touch this company. I actually wrote to Warren Buffett because it was around that time, 2007, 2008, where he said, if you have a great founder-backed company that you think is, misunderstood or mispriced by the market, let me know. I'm open to hearing the idea. And it was a, $2 billion company back then. So we've made, 35 times our money on a convenience store chain. But those are the types of companies that can, you don't need to find a lot of them, and they're not novel or new. They're not AI disrupting or climate changing. They're just good operators that are winning in a niche where there's a lot of cash to be generated if you're disciplined and ambitious.
And yeah, that's and your job then is just to hold on, to keep invested. And so one thing that I'm interested in is then during that holding on period is, what are you looking for then to suggest that this compounder is gonna end? Because businesses don't go on indefinitely. Things change. An investment can run its course. So what are those, maybe not so much red flags, but they're beige flags that are popped up there that you're keeping an eye on to say, hey, is this compounder turning into something less exciting? Because it's always about that, the future prospective return.
Yeah, so we've become quite serious in this, but compounders is a banned term in our office.
Luckily, that door is closed.
Yes. No, because they're only known in hindsight. The people who think they've identified a compounder with foresight have probably overpaid for that compounding stream, and thus may end up trailing inflation depending on how much they've overpaid for it. And so that's why it's becoming, companies are coming in and saying we're a compounder and you should look at us, and we're just like, who's not saying that? Great companies. And so the framework here at Langdon it's very operational. We're looking at the sources and the opportunities for revenue growth. We're looking at their ability to take price or expand margins. And then we're looking for what conversion from net income to free cash flow should we expect. So it's those three things. It's top line margins and conversion that ultimately dictate or drive that compounding potential, but you have to break them into their components. And so to answer your question, we would be looking at, what are the markets that they serve? At what rate are those markets growing? What is driving that market growth? How much incremental market share are they taking, if any? And what is driving their ability to take market share? And so, you get the market growth, market share piece, and then you look at the income statement to figure out what are the incrementals margins. Like, so for the next dollar of revenue, how many costs? What are the costs associated? Because growth costs money. You got to hire salespeople. You got to hire a back office to support the growth. You might have to hire, a servicing team once you have a much bigger book of customers. And so all that stuff costs money. And there's usually layers to it as well. Because some of these companies start quite small and they might be in founder-led sales, and then they get a little bit bigger and they're able to hire multiple sales teams, or salespeople, but then they organize regionally and they need another layer of sales leadership under that. So, we're obsessively focused in the operational DNA of the business. What are they doing to sustain their, right to win from a competitive standpoint? And then we have our own views on the market and the market growth, because if we're just asking management, you mentioned at the outset the trust but verify piece. If we can't go independently assess everything they told us and verify that it was as they said, we're not going to invest. And so that compounder beige flags would be, things like irrational competition. Like us personally, we would rather invest in bad times. We think that great companies navigate challenging environments extremely well and end up better on the other side of those challenging times. So we're like quietly rooting for, a negative economic period for a sustained period of time. And through those periods, there will be some irrational competitors that are just trying to get market share or generate revenue growth at whatever means necessary. They might be discounting their product. These things that are unsustainable long term, but they can persist in the short term that totally screws up the industry for a period. Everybody suffers when you have one irrational competitor. And so we look for things like that because it can cause short-term issues in that compounding journey. But those often end up being, great opportunities for incremental capital if you believe that you've backed the right team. So, it's probably not a formal list because we don't think about it from that way. We think about it more from top line margins and conversion, and then we just want to understand how those things will persist.
Let's go into trust but verify. If anyone's ever read any of your material, listened to you guys speak before, trust but verify is integral to the investment process. And that's about getting out there and getting boots on the ground and going to the places where these companies operate and doing your due diligence. There's a quote I got from you. The best investments are observations, not predictions. Give us some examples of that. I presume that means about getting out on the ground into the factories, into the offices, the warehouses, the places where the products are actually sold.
Yeah, and it sounds like they sound dramatically different, but the difference is subtle in reality, right? Observation versus prediction. And I think sometimes people think they're making an observation when in fact it's a prediction. And that can be dangerous. And so, that would look like, this company is great and their products are going to be super successful all around the world. And it's like, well, that is a prediction because they've actually never hired anyone or sold that product outside of their home region. So while there might be some logic to what you're saying, you are predicting. So what we would wait for in that instance is for them to have opened a field office in the countries that they're looking to now further penetrate, have had some early success with some level of customers where we can say, okay, it is gaining traction in the UK just as it did in Australia and Canada. And so we now feel like we're just needing you to keep doing that as opposed to we're hiring you to do something you've never done before. That's the prediction realm. And so we do think it's important to do that in person on ground and to be very, discerning in how, and this, especially as a global investor, there's a lot of Aussie companies that think the US is, a big world to conquer, not realizing that it's very different over there versus Australia. And we can talk about some of those examples. And same with, Canadian companies, anytime you grew up in a smaller market and you want to, win in that bigger market, as we were talking about earlier with Couche-Tard, the level of preparation they put into, to doing that before they did it, right? They had mapped. Big Oil used to own all the convenience store chains, the big convenience store chains, because they were integrated refining upstream and retail. And they knew which oil companies owned which chains. When the CEO, because the CEOs of these companies are like politicians, they change every 4 years in these big oil companies. So when the last CEO had been hired, how many sites, what the amount of capital would be required to improve those sites to put it on their standard, or if it's private equity owned, which fund is it in, which sponsor owns it, who is the sponsor that sold it to the current sponsor. The level of detail and preparation is what gave them the confidence to think that they could win in this new region. And so that's the type of stuff we want to go see. And so one of our checklist questions is, show us your war room. If you think there's a consolidation runway for your business, is this a think? You think that there is, or that there is? And the only way you know that there is because you've done the homework. And so show us your homework. And that's usually something they're willing to do because it's not, material non-public information. They don't know if they're going to be able to buy these companies. They don't know if they're going to be for sale. If they are for sale, at what price they'd come for sale. So we're not asking things you can't know, but we know we're asking things you should ask to kind of be able to tip the scale from we think to we know. And so that verification element, and I can even give you examples where we thought something, we went there and found out it was not what we thought. And then we just didn't invest.
Okay, what's an extreme example of that?
Well, it's a recent one. You can tell me if it's extreme. It was quite memorable. We were in Poland 3 years ago, 2.5, 3 years ago, myself and Mansour, who covers Europe. And we'd been pretty successful investing in a number of, QSR concepts, quick service restaurant concepts in different parts of the world. And, again, all roads lead back to Don May, but the head of Europe at Domino's Australia had retired pre-COVID and then showed up as, the chairman of this Polish pizza chain called Domino's Poland, DP Poland, and very, very small company. I knew Andrew Rennie from the time that he was at Domino's Australia running Europe. He'd done a great job. And we looked at the business and thought there was an interesting opportunity. He was putting his own money into the business on a very small company, 40, 50 million at the time. And, we were in that part of Europe for a number of reasons, and it made sense to extend the trip to get to meet Don and his team in Poland. And they had just made a pretty large acquisition of a competitor. And, the math looked really interesting. They're, doubling the store count. So we said, yeah, we'll come see you. We know what the playbook usually is for these types of things. You need to improve your delivery, your route density on delivery and your delivery times to customers, because that's what improves order frequency. So Domino's calls it the high volume mentality. And we went and toured a number of their stores and realized probably after 3 visits, like, they didn't buy a competitor like quick service pizza chain. They bought a restaurant chain. It had a huge kitchen and a dining area, and it had like a pasta bar. And this was not, what you would expect from a tiny hole in the wall, 10 delivery drivers lined up outside, quickly rushing orders all over the local area. And when we went to the headquarters and called the 1-800 number of one of the locations to order, and it was still the old company's name. And so in the press release, it said, synergies have been extracted, totally converted the stores that we bought to the new store concept, blah, blah, blah. And we just went, no, there's a lot of CapEx required here. And the balance sheet didn't look great at that time. The largest shareholder also had a loan into the company and at a below market interest rate. And so we just said, this is a bit too early for us. We would love to see you after these stores are on level footing with your existing stores. And so had we not gone there, like the spreadsheet math and the company's communication made it sound like the heavy lift was behind them, and our boots on the ground view was, no, the heavy lifting is still ahead.
That's really interesting. And it's funny to think back to a pizza restaurant that has a pasta bar and all that kind of stuff. It's like stepping back in the 90s. We have not had that here in Australia for a long time. I want to then come back, because I think this is a good spot to bring back into the conversation. Your interrogation under duress. Is that what some of these management meetings are like?
I think there's degrees, right? Duress in the investment world is not...
You're not waterboarding them.
No, certainly nothing like that. But it is, the benefit of the upbringing I had in this industry is I've seen it done so many ways, and I've done it a number of ways myself. And so and now as a, global traveler, both from a meeting of clients standpoint, but also meeting of companies, you're at your best when you slept at home, took your commute to work, grabbed your local favorite coffee, you're sitting at your desk, and, somebody wants to come in and visit with you. When you're 14 hours jet lagged and, the hotel you booked was on the second floor of the hotel, and all you heard was what was going on the street, and then you're up at 8 and you got 7 meetings back to back, you have to kind of put into context what the people that are coming to visit you are going through, or what you're going through when you're visiting these companies. And so the interrogation under duress is more that you want to see them in their environment. You want to see them, within their local comfort zone, but then you also want to see them after their worst earnings result, in their 7-year history running the business, stocks down 40% the prior day. You want to see them at a 52-week high when it feels like they've had 3 straight years of everything going their way. And you want to build that mosaic of understanding the humans that run this business and the culture of the business by not guessing how they'll behave. And so in some cases, we followed these companies and these teams for years. And what we're trying to do is make sure that it sounds the same in good times and not good times, in periods of stress and periods of of success. And we think that that's a common theme among great companies is they don't get too high, they don't get too low. Like there's tons of analogies to sport where these teams, great successful long-term teams, have stable ownership, stable leadership within the management teams, and then stable locker room leadership as well. And they live in a very narrow emotional band, and that is what allows them to not let their emotions get the best of them and perhaps make suboptimal decisions. And so we call it interrogating because that's what it is. We're on a pursuit for the truth. We want to understand what is true, not what they think is true. And oftentimes it just requires a substantive investment of time and effort. We've read every spoken word that they've ever given, going back to their, commencement address at whatever alma mater that they came from. We'll have caught that interview as well. And then we'll also have listened to anything that they ever did. And then when we're interviewing them, we're usually asking them questions we already know the answer to see how they answer it a variety of ways and under a variety of circumstances to make sure it's true, because the hindsight narrative in this business can cost you a lot of money. People today look at Microsoft as this like wildly innovative, disruptive business, but I'm pretty sure 13 years ago it was 10 times cash earnings, and people thought that they were monetizing outdated product and had very, very low growth prospects. And so now you just came to the Microsoft story today, you'd think one thing, but if you'd been consistently meeting with them through the Steve Ballmer era and some of those really difficult years, you'd have formed a totally different view. And so I think it's important. That's why we talk about, number one, follow the right companies, and number two, pay the right price, because you want to have built relationships with these companies so that when the dislocation event occurs, you're not starting your work. And so a lot of that verification has been done. You've built trust and a predictive comfort with the company. You're just waiting for that attractive price.
Something that you guys do is actually invest like a local, meaning you go and spend sustained periods of time in specific regions. Like I read that you took your family to a neighborhood just outside of Paris for a month to get on the ground. And one of your other colleagues spent significant time in Australia and Japan to understand, to shop in the supermarkets, to live there and use these products in the local setting. I think that's really, really interesting. And that doesn't come cheap either. Like, that's a significant expense to a business. And I think that's maybe something, this type of analysis that you go into, you're not just reading research reports. And I think some people might find this surprising. You're not just a portfolio manager reading third-party research reports and piecing together a portfolio based on that, because there are managers out there who actually do that. You're spending cash from your business out of your own pocket to go and live in these environments and truly understand these investments before then putting your client money to work, because it comes back to your earlier statement of who you're serving. I think that care kind of is baked in throughout the entire process of that trust but verify. That's really important to me. I really, it's something that I really resonates with me. Now, I want to move on. How Langdon has actually come to Australia, and one of your original founding affiliates or partners is an ASX listed business here, Pinnacle. Now, Pinnacle basically takes stakes. For those people in Australia who don't know, Pinnacle, PNI is the stock code, takes stakes in fund managers domestically here in Australia and around the world. So they take a minority ownership stake, and they then provide you with the infrastructure and support to grow your business. I've heard you actually refer to working with Pinnacle as saying it feels like you're working with a group of entrepreneurs. What does that mean? How does that look in your world, and what do they do for you?
Yeah, I hope. I mean, I still believe that we're almost 4 years into the partnership, and whatever honeymoon phase people say exists in the early days, I know we're through that, but I still feel like we've found the right partner, and And anyone in any job setting can appreciate that sometimes, when you're in bureaucracy, right? Like you might be halfway through the meeting and all of a sudden going, oh man, this is, versus, when you're talking to people who are, entrepreneurial. They just want to get to what matters. They just want to get things done. They want to know if there's a better way. They want to do the right long-term thing. They worry about reputation as much as they worry about, bonuses, if not more about reputation. And so to me, there's this very distinct feeling I get when something feels entrepreneurial versus bureaucratic. And so having come out of a firm, my previous I worked at Fidelity for a number of years, but then we went, we were lifted out by a multi-affiliate here in Canada. I spent 10 years with them, and we ended up building a pretty significantly sized firm. And then, somewhere along that way, you just go, well, this feels kind of bureaucratic, and where I hadn't intended for that. I wanted to be part of something entrepreneurial. So, we talked to 18 different firms before partnering with anybody. I knew that we needed support, because I wanted to, like, as I said earlier, to offer our services at a $5,000 price point where clients in 20 countries around the world can go online, go on their phone, go on the internet and select us, because the distribution counterparties have deemed us worthy of their clients' capital. That's a big responsibility. And it requires us to do certain things to de-risk the firm for those counterparties. And so after meeting with a number of those, 18 different people, everybody wants to be your partner if they can own 51% or more, because it's more like a call option. And if it doesn't work, they can just shut it down. And I'd come out of an environment where, I learned the difference between being, a well-paid employee and an owner. And I was convinced that I was only going to bring my best self to work every day if I was well and truly an owner, and everyone on the team was an owner. So control of the business was a non-negotiable, and that's Pinnacle's model. We were, I think, their 15th investment going back 3.5 years ago, and their first in North America was all done by Zoom because of COVID. So I was able to fly to New York to meet one of their team members prior to signing, I think actually they flew up to meet me in Toronto. But apart from that, we were able to get it all done over Zoom, and it felt like, they were your partner, arm in arm. Let's go build this business. It was not a check writing exercise. We have, 2 people in our office today in Toronto that have, semi-permanently or permanently relocated from Brisbane. And we have a third person that is employed by Pinnacle handling compliance that we hired here locally. And so their DNA is all over our business to date. And they've been instrumental in helping us as investors focus on the investing piece. And so I think a lot of these early stage firms, they think if you're a good fund manager, you can just like put runs on the board and eventually people will find you. But like the reality is you'll be running a small business forever, because you can't be the business owner and the fund manager. And there's a lot of other important functions that need to get done at a very high level to build a successful investment boutique. And so I just knew which one of those I was uniquely skilled to take on and which ones I wasn't. And I'd had the experience of that prior affiliate or multi-affiliate to know how important it was to have that support. So super pleased with the relationship. And yeah, it definitely still feels like we're not talking to a $4 billion ASX listed company when we have our quarterly conversations or, ad hoc conversations. It's just a group of people like that would do anything to support you, and will, any reasonable request can be actioned. So
I think that's great. That's great insight for how they operate and who they are. And that's been my experience as well with dealing, just say even organizing this conversation. They've been fantastic in helping us do that. I want to get into who is Greg. I've listened to a lot of Greg Dean podcasts leading up to this. I have probably gone through about 5 hours of nonstop Greg Dean. And so I've picked up something, and it's coming through here too. I think I'm on the money. You can tell me if I'm wrong. There's a certain level of intensity to you, but also I think there's a certain level of scrappiness, as in not in like rough around the edges. Because I mean, looking at your hair, you're tidy.
It's a haircut today.
Yeah, it's looking sharp. But there's a scrappiness to you. There's a fighter to you. You want to get out and rattle cages of management and point out corporate bullshit. You weren't happy at a big, with the status quo of a big corporate fund manager. Am I off the mark there?
I mean, it's hard to self-diagnose, right?
You're on the therapist couch now. This is officially the therapy part of the interview.
No, you've touched on some really, I think, important things. Those are in many ways some of the, I think, positive qualities that I would identify with, that in some cases can come with flip sides to those coins. But there's a couple things I'd elaborate on. One is just complacency in any phase of life can be a death sentence. Like it just can kill. It certainly kills excellence, the ability to be excellent. And in my view, excellence is just sustained high output, high performance, doing it for a really long time. That's always been something that I've been, wired to try to do. Wasn't going to get where I wanted to with sport. So it kind of quickly pivoted to, trying to use other skills and tools, but realizing that you're not going to get very far alone. And so needing to surround yourself with, brilliant, capable, driven, curious people, is definitely something that I learned early on in my career, and just learning from these, like, I still can't believe I get to come to work every day and interrogate these world-class business leaders and find a way into their Rolodex. I've been doing the same thing for 15 years. And you realize, like, that is, you have to match their intensity. You have to match their drive and the level of preparation that they put into their day to day, or they're only going to kind of give you a certain amount of their time. And I kind of saw, the things as you go through life and as you go through your working life, you see things that you think you could do better or should be done better. And eventually you decide, are you going to stand for not doing it better, or are you going to try to, edge it forward in a way that you think is better than the way you've seen it done up to this point? And so we had to kind of create an environment that would foster that. It's hard to do that in big companies,
Yeah, no, I get it. I completely agree. Now, I have heard that when you grew up on autobiographies, just devouring autobiographies. Who predominantly resonated with you, and why? Which one kind of, when you think back to young Greg Dean, and I've got some quotes here as well, actually. As a teenager, you came to realize the realization, and this is very profound for a teenager, I've got to admit. You wanted to marry people with numbers and math, and you were heavily into biographies. We're painting a picture now of Greg Dean as a teenager. What biographies were the ones that really resonate with you and that you still think about today?
So this, even before I could have come up with what you just said, which I did realize in my late teens, but early on, like if you looked at my childhood closet, it was like baseball players, hockey players, basketball players. Like I was just obsessed with learning about how athletes became successful, like the work ethic, the habits, the day-to-day, the things, because when you see them on TV, that's such a short existence of their lived experience. There's so much that goes into their ability to perform. And that was sort of like, so it would be these local, like Roberto Alomar, Joe Carter. I had an Eric Lindros biography that I haven't read in probably 25, 30 years, but I've read it. I read it 10 times when I was 13. Like these were just that was the beginning of sort of what I now realize. You can only connect these dots again, and with the benefit of hindsight, is I'm going into these autobiographies about world-class business leaders now, and some of it is through a book like the one I mentioned, but some of it is through just what you can collect, through ChatGPT and the internet. And about this person, you're building the autobiography. You're basically trying to put the pieces together to understand who they are, what have their experiences been, And I think I'm always trying to take the learnings from others whenever I can, good and bad. And then, it's the wonderful ability to avoid mistakes, learning from others' mistakes. You don't have to make them all yourself. I'm a big believer in, just, it's okay to make new mistakes. You don't want to make old mistakes. That is when it can get quite frustrating. So, I'm not sure one stands out above the others, but I think I just was sort of brought up. There was a brief period where I thought I could be a self-taught investor. And that was more out of necessity because I wasn't getting jobs in the industry as a student. And I saw my friends and, other classmates getting these great jobs. And I thought, well, you know what? I'll just take a different job and I'll, in my free time, figure out how to do all this stuff. And that was sort of the marrying of the people with the numbers, where I realized, no, I need to be around. Like I'm a kinesthetic learner. I need to see how this is done at the highest level. And that will be my hopefully my quicker road to understanding how to do it myself.
I love that. That actually just comes straight back full circle into that scrappiness. Like, you know what? I can be an investor. I don't need, I've got the internet. I've got a brokerage account. I can invest. I don't need to be employed by a Fidelity or a Magellan or whoever it might be. That's really cool. I've got two final questions. If you could go back in time and tell young Greg Dean something about life, business, or investing, what would it be?
I'd have a lot of things to say. You have to put in the work, but also that the timing might not be fully in your control. Like there is an element of have the patience to and just almost like the faith to realize that the right opportunity at the right moment will materialize. But then the key thing is to capitalize on it. And I think I've never been termed a patient person. I think of it more as having high standards for, my effort and my time. But at times in my, especially, younger years, that impatience wasn't always helpful and probably caused me a lot of, stress or consternation thinking that things should happen faster. But when you look at the big decisions in my life, I feel like I handled them so far pretty well, both like personal and career. And that is, I think, due to, luck, obviously, but also preparation. Like you have to, even down to like, where we live. Like I met the seller of our house in an Uber, but I'd done so much homework on the neighborhood that he ended up telling me in this 10-minute Uber ride that he was selling a house in, that by the end of the Uber ride, I was ready to buy his house. And so like, that's a total luck circumstance, but it was met with the preparation of, I knew the houses on the street, all the like minute details of which ones we'd be interested in, sizes, bedrooms, that sort of thing. And so this is a personal story, but it's kind of the essence of, luck meet preparation. And that's why I think, like it rings true at Langdon. We do an obsessive amount of work, ideally well before the opportunity. And and some of those opportunities never come. And you just did all that work and it didn't go anywhere, but that's okay too, because you're trying to be prepared for those infrequent large opportunities. And I've been fortunate to experience a few of those in my career, Pinnacle being one of them. That was a chance connection by a fund researcher in Australia who had previously rated my old strategy, but that was them connecting us and look where it's taken us.
I love the reframing of impatience to just high expectations of my time. That is now what I'm going to think of if I say, geez, that guy's impatient. No, he's just got high expectations on his time. I love it. Right, Greg. So my question is, I'm flying over to Toronto. We're catching up. We're going out for lunch. The out of office is on. We've got low expectations on our time, but maybe high. I don't know. Where are you taking me? What are we doing? What are we eating? What are we drinking? Where are we going?
See, I contextualize all of this. Until I know, I would need to know so much about you
This is your preparation again.
Where I would take you, exactly, yeah. But my default would be there'd be two places, and they're actually quite close to the office here. There's just a great deli, and I think deli is one of these meals that is, goes around the world really well.
We really don't have it too much here in Australia. It's starting like cool, kind of like trendy ones are starting to creep in, especially I'm in Melbourne. And you're starting to see all these little small sandwich deli shops opening. But they're very cool.
This one's not cool. This that it goes back to maybe a bit of that impatience that you've helped illustrate here, but I don't do great in lines.
I don't line up for anything.
You got to know where you can go that's good, very good, but you will not have to wait in line because it is just not good enough that there needs to be this sort of, whisper fan, halo around it. And so the two restaurants that I typically take people from out of town, and we host a lot of international executives, and it's not at the places that you would think. It's a ground floor deli that's been in the same place for 30 years.
What's it called?
It's called New York Deli on Bay Street, right just south of Bay and Bloor. And then in my old office, it was a place called, it was a Greasy Spoon that just had, a $4.99 eggs and bacon breakfast. And the further the companies were from Toronto, the more likely I was to take them there, because over breakfast, these are just simple. It's a simple meal. The focus should be on the conversation, not having to do mental gymnastics to figure out what to order and how to pronounce it and this sort of stuff. So, it also helps people understand who we are. Like we're very adaptable. We can be put in sort of any circumstance, and we'll manage.
I've just Googled it, man. So I've got New York Deli, Bay Street, Toronto, the Reuben combo, smoked meat combo. There you go. Cup of soup and a sandwich. $18.90, 18 Canadian.
But they have breakfast. They have breakfast all day.
Yeah. Oh, there you go. Well, I mean, if I'm flying, it'll probably be because it's. We started this chat at 6:30 this morning Australian time. It's actually, geez, we've been here for a while. Greg, I really appreciate you joining us. I thoroughly enjoyed this conversation. I hope it's the first of quite a few to come, and I hope if our listeners have enjoyed this, please let us know. And if you want to see Greg again, please let me know. Greg, thanks for joining us, mate, and we'll catch you again soon.
Appreciate it, Owen. Everything you've done with your platform, I admire it. I think it's really important to be getting, end investors more familiar with what's going on in the investment world.
I do have to pull you up. I'm Owen's offside. I'm Mitchell.
We'll edit that out.
Man, Greg, this has been great. I really appreciate you. To be fair, I'm leaving that in. All right, yeah, mate. You have a good evening, and thanks for joining us.
Cheers.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.